Hi, everyone. Welcome and thanks for joining us for our webinar today, co-hosted between the Credit Union and HUCTW. As always, we want to thank the Credit Union for this partnership that makes these special opportunities available for our members, and particularly thanks Sarah Scruggs and Migdalia Gomez, who are here to speak with us today. We do these series throughout the year and on a wide variety of topics, so stay tuned in January for the 2021 schedule. And if anyone has questions, there is a questions section where you can enter that for the presenters to respond. And thank you all for being here today. And with that, I will hand it off to Sarah Scruggs to start us off.
Thanks, Danielle. Hi, everyone. Glad you've made it here with us today in this virtual space. We are glad to have you on. We'll be talking a little bit more about refinancing and debt repayment today. So hopefully you are looking forward to this information that we'll bring, as well as hopefully you have some questions that you'd like answered today. And so I'll get right into it. The first being, we will go through what we have today and answer questions possibly throughout if there are some that really resonate with specific slides. We'll also have time for questions at the end, of course. We have gone ahead and muted everybody on the call except for our presenters because we want to make sure that you can eat your lunch if that's what you're doing today. We want to make sure you can hang out with your kids if that's what you need to be doing right now, but also getting this information. So don't hesitate if you need to step away. That's also perfectly fine because we will be recording today's session. And that will be available for everyone to view. So if you missed something, it's okay. You can go back and view this again. Like Danielle said, there is a questions feature. Because you all are muted, we don't want this to just be us talking the entire time and you not being able to ask those questions. So you can find the questions feature either on the right-hand side of your screen or at the top of your navigation. It may say questions or chat. And so if you found that, if you could please let us know where you're joining us from today so that way we know, number one, you can hear us, and number two, that you know where the questions feature is so that you can ask any questions you may have throughout our time today. And it also gives us a good idea of where everyone is joining us from today. Weymouth. Awesome, perfect. Somerville, got some people joining us from Cambridge, Boston, Dedham, Manchester, Melrose. Great. Thank you all so much. So glad you can hear us, number one, but also really glad you've joined us today. The Harvard University Employees Credit Union, or HUECU, as you'll probably hear it, is a not-for-profit financial institution exclusively for the Harvard community, and all of you are eligible to join us at the credit union. We offer everything that a bank does, except we believe we do it a little bit better. And we are a little bit different in the sense that all of our profits go back into our community. We offer lower rates on loans, higher rates on savings. And once you're a member for life. So even if your relationship with Harvard does change in the future, you are still a member at the credit union. So if you have any questions about membership or anything specifically about credit union products, we're happy to talk about that. So please don't hesitate to reach out to us as well about that. Like Danielle said, we are getting ready to plan all of the presentations for next year. Cannot believe it's already almost 2021, but really looking forward to that and hopefully putting out a really great schedule for y'all next year. So be on the lookout on this page, huecu.org/HUCTW, in late January for any updates that we have for the schedule for this year. And Danielle is great about sending out these announcements via email as well. So if you're interested in that, make sure you're looking on your inbox. You can go to this page if you're interested at all in seeing the past presentation that we did just a few weeks ago now, money management during the pandemic. That recording is there. And this is where the recording will be for our presentation today as well. So let's jump right in and talking a little bit more about refinancing and debt repayment. Before we can really get into the nitty-gritty of either of those topics, we really have to think about what does today look like? What financial situation are we in right now? because a lot of times we're either constantly thinking about the future and what this could look like or what this may look like, but really we want to ground ourselves in what is happening right now before we take those steps about the future. So how do we do this? The first way to check to see where you are today is to think about an emergency fund. Do you have an emergency fund? Is that something that you have in your bank account, easily accessible? Have you been saving up for an emergency fund? Maybe you're starting at ground zero and you're like, Sarah, what is an emergency fund? That's great too. An emergency fund is money that you have put away and that is ready to take on any emergency expenses that may be coming in the future. And so experts recommend that it's anywhere from 3 to 6 months of your expenses. So this can be a really big number for us, especially here in the greater Boston area. Our expenses are quite high. Of course, in thinking about our mortgages, our rent, and all the things that go into that. So we really recommend that you calculate these expenses. This number again is going to look really high and maybe a little bit scary. I know for myself, it's pretty scary. But I recommend calculating your expenses for 1 month, figuring out what those are. So do it for 1 month first, then do it for 3 months. What will you need to cover for 3 months? What would that 6 month number be like? Maybe you're already there. Maybe you're like, I totally have an emergency fund, all good to go. Um, and maybe you're just starting out, but it's so important to make sure that you have these funds so that if a future emergency does happen, you're able to cover those expenses with money that you already have and not money that you possibly have to borrow. And like I said, you have to start small and build on that because you're not going to go from 1 to 1 million overnight. That's just not how life works in any sense of the word. But starting small and building is going to get you there. So maybe it's putting $10, $15 out of every paycheck going straight into a savings account for yourself. So that it may not even hit your checking account. It may go straight to your savings account. But start small and work up to 3 to 6 months of expenses. And then thinking about debt repayment. If we want to know how we can better pay down our debts and work towards possibly refinancing or even just repaying some of those debts, we have to know what debts we actually have and what we're also paying on those debts. We do have a chart that you can fill out on our website. It's at huecu.org/hub. I'm sure Migdalia will put that in the chat for you all. But this is where you can download our list of debts where you can write out, okay, this is how much I owe still. This is the interest rate that I have on it. And we want you to add a column on that, monthly payments. How much are you paying per month on all of this? Because if you start looking around to refinance some of this debt, if you have no idea what the interest rate is on your debts right now, then refinancing, looking around for that, researching, that's not going to help you much if you don't know where you are today. So list out these things, make sure that you're being honest with yourself. Again, this isn't like the most fun topic to cover, I'm sure, with yourself and with your family, but it's really important to do so that you can put yourself in a better situation for the future. Now we get into the part with all of the numbers, which can be quite confusing. But what I want to kind of make known for everyone is that you don't have to do this alone. We do have a calculators webpage at HUECU. So if you go to huecu.org/calculators, you can do all of this math there. So don't get too discouraged about doing mental math because I know I do myself. So I'm thankful for our calculators there. So we've listed our debts. Those are in column L, or the left-hand column, and then you have the interest rate, the terms, as well as the monthly payment. So the total interest paid is listed out to the very right. you want to see, okay, over the life of this loan, how much will I actually be paying in interest just to have this loan? And so then you add it all up together. What are you paying every month for all of your debts? What are you paying over the life of these loans in interest? Adding it all up will help you see the full picture. Okay, this is where I'm at today. Getting into refinancing, I know you've probably heard rates are great. That's what people are saying. A lot of people are kind of taking the first step to learn a little bit more about refinancing and think a little bit more about this for themselves and their families. And so I'm going to take you through a couple of different things to think about, as well as what loans you may possibly want to think about refinancing at this time. The first being, when you're thinking about refinancing any debt, um, depending on the lender, they may be looking at your credit score before they can refinance for you or before they can find a rate for you. And so we really recommend that you go on and check your credit report at annualcreditreport.com. This is the only website that's authorized by federal law to give you a free credit report. And your credit report will tell you kind of like the backstory of your credit score. So maybe you get your credit score through an app or through your credit card. I know I get mine through my credit card. And so I know that. But I want to know a little bit more about the details. What loans do I currently have? What loans have I paid off in the past? Are there any collections on my report that I need to figure out and deal with? If you go to annualcreditreport.com, you can download a free weekly copy of your report. Sorry about that. A free weekly copy of your report from each of the three bureaus up until April 2021. This may be a little bit odd because you're thinking, okay, annualcreditreport.com, free weekly credit report. Well, due to the coronavirus, they've changed it so that you can get it once a week. And although I wouldn't recommend looking at it once a week, it may not change too much week to week. It may be interesting to look at your credit report maybe once every 3 months and get a good feel of where you're sitting. And make sure that everything on your credit report is accurate. That's a really important thing when you're thinking about refinancing and interest rates. So there are refinancing options for all of these loans. You could refinance a personal loan, you can refinance auto loans, all the way up to refinancing your mortgage, which a lot of people on this call definitely had a lot of questions about, and we'll get into a little bit more later. But know that there are options for all of these. So maybe you have some loan debt that you're wanting to refinance, but you're not sure really where to start. We always recommend starting with your financial institution, asking them questions, seeing if there's more that you can learn from them. Of course, we're a resource for all of you as well, and happy to help with those. So we'll go over a couple of different, probably the most popular refinancing questions we've gotten, and just go into a little more detail about those and what are the steps and pretty typical rates that we've been seeing in the past few months. The first being education loans. You possibly have an education loan, maybe for yourself or possibly for children or any family members. And these can be federal or private loans. If you have federal student loans, right now is not a great time to refinance those because you are at 0% interest and there is not another lender that can get you to 0%. No private lender can put you at a 0% interest rate. It's just not going to happen because private companies don't have the flexibility that the federal government does. And we also say don't refinance your federal student loans at this point in time because there are benefits that could be coming in the future that we don't know about. We don't know what the new administration is going to put into federal student loans. We don't know the decisions they're going to make, but the benefits of a federal student loan highly outweigh the benefits of refinancing at this point in time. Is this always the case? No, it's not always the case. But at this point in time, it is good to stay with your federal student loan. until we learn a little bit more about what is to come. If you have a private student loan at this time and you're thinking about refinancing, it could possibly be a good time for you. This could be a time to start checking out some rates. Here at the credit union, we have a fixed rate as low as 4.5% at this time, and the variable is as low as prime at this point. And of course, different terms for the different lengths of loans that you possibly may need. And you can apply online, so directly through our website for a refinancing there. But what we always recommend is checking out different options. And if you are thinking about refinancing a specific product, maybe like a private student loan that you have with company A, and you're thinking about refinancing it with company B, C, or D, if you start checking out those things and they need to pull your credit report, make sure that you're doing it within a 2-week period for one product, because if you're doing it for the same product, so a student loan, within 2 weeks, they'll only hit your credit report one time. So it would only affect your score one time instead of 3 different times. Let's say if you did it over a 2 to 3 month period. So if you can do it within 2-week period, then your credit score will only be hit one time. So that's the best option to use. But if you're interested in education or student loans, and you have a private loan already, this could be a good option to save a little bit of money. If you've listed out your debts and you see that this is a good option for you, definitely do a little more research for yourself. Of course, the next one being mortgage refinancing. This is the most popular because I'm sure, as you've heard from a lot of people, maybe your parents have already refinanced, maybe your friends and family have refinanced their mortgage recently, but rates are at historic lows. We do not at this time see them going down any further at this point. Of course, never say never, but we do see them, they are at historic lows. If you're sitting at, a rate that is higher at this point in time, we are seeing rates about 3% interest for a 30-year fixed loan. And so if you're sitting, a percentage higher than that or even more, then it may be a good time to start thinking about it. But what you have to do is you can't just look at, okay, this is the bank that has the lowest interest rate. You also have to think about the closing costs, the fees, the other things that are going into refinancing your mortgage. And you need to compare all of these things to get the best price for you and your family and to find the best option. The best way to do this is to reach out to mortgage loan originators. We, of course, have a team of 4 mortgage loan originators at the credit union, and I'll be completely honest with you all. Every single mortgage loan originator, probably in the country right now, is extremely swamped with the amount of work that they've put in over the past few months on refinancing mortgages. So definitely reach out proactively if you can. If you see rates that you feel are good for you and your family, reach out to a mortgage loan originator and see if they can provide you with the other costs that may be associated with refinancing a mortgage with them. If you're interested in following the rates at the credit union specifically, you can sign up on our webpage for Rate Watch because rates change every single day. It's pretty crazy to think about that, but our rates at the credit union and around the country at different banks and financial institutions are changing every single day. And so it's important that you're keeping up with those rates. If you're really looking for a specific rate, or you say like, okay, I'll refinance if it goes under this certain percentage or interest rate, then signing up for Rate Watch on our page and maybe other pages is a good idea for you all. And the entire process of refinancing, you will be walked through that with a mortgage loan originator. And so you'll have a person to contact, a person to ask questions to, a person to think through the list of documents that you'll need. My mom refinanced earlier this year, and that was her biggest hurdle, was getting all the documents together. And so she had someone there telling her exactly what she needed to make sure that the mortgage process would be easy and comfortable for her. So I highly recommend reaching out to a mortgage loan originator so that they can give you additional information about what you specifically need. Researching tax laws. The prior two slides that I talked about are two of the interest rates that you could possibly deduct from your taxes. And so I highly recommend, if you have already refinanced or if you will refinance in the future, look into both of these as well as home equity. So if you're interested in a home equity loan as well. Research the tax laws around these. The IRS is the keeper of all of these laws, so you can go to irs.gov or consult a tax professional. But it's important to note that some deductions may not be applicable to everyone's specific situation, but it's a good thing to know, okay, I possibly have a deduction that maybe I didn't know about before, so I need to look out for this when I'm doing my taxes again. And consult a tax professional if you do have any questions about these different deductions and tax laws.
Sarah, before you continue, I do have a question that came in. Someone asked, they have federal student loans, and we mentioned that the rate is 0% right now, but that their FFELP loan has been charging interest this entire period. It may be loans that were issued, and I'm blanking on the year. I want to say it was around 2000, early 2000s, but there was a point that even though you had a federal loan, it could have been issued by a private institution. So it may be that the loan that you have is not actually federal, but may have actually been a private loan. I would recommend in situations, if you believe you have a federal loan and that interest rate is not at 0, to contact the servicer. I will also provide information, as I'll add it on through the chat, as to where you can go and get the information from the student aid. But the rate right now should be 0 for all federal loans that are held by the federal government. If it's held by another entity, it may be that it may no longer have been a federal loan, or may not. Essentially, that's what I would think of. So I would recommend contacting the servicer directly, and for anyone that this may apply to. And I'll provide that information in the chat. That's all that we have right now. Sorry to interrupt, Sarah.
No, thank you so much. Yeah, absolutely. And thank you for that question. It is important, like we said at the beginning, to know your rates. So if that is happening, you know exactly who you can contact and who to reach out to about that. And so thank you, Migdalia, for that. Another possible opportunity to refinance, if you have a car and you're possibly thinking about refinancing there, 2.99 is the special rate that we have at the credit union. So if you have anything above that, it may be a good time to go ahead and refinance, save a little bit of money, save money for those monthly payments, or possibly lengthen the life of the loan if you want to pay less every month. And here at the credit union, there's no payment for 60 days after signing that refinance, and you can apply online. All you need is a recent pay stub, a 10-day payoff letter of the car, and your insurance binder for your car. And that's all you need to apply. It's an extremely simple process. Auto refinancing is definitely not as specialized as mortgage refinancing. So with auto refinancing, it's pretty straightforward. And if you have a rate that's way above that 2.99, this could be a good opportunity for you. And if you're interested in this, it is a special rate. So I would encourage you to act quickly if you're interested in refinancing with the credit union. But of course, please do look around for the best rate for you, because this is a great rate, yes, but it may not be the best for you. And at the end of the day, me and Migdalia want whatever's best for you and your family. Before we would ever say, no, you should absolutely do it with the credit union. We want whatever is best for you all. So do your research, look around, see if there are better rates out there. But this could be a possible another refinancing opportunity for you. And at this point, I am going to throw it over to Migdalia to talk a little bit more about debt repayment and opportunities for that.
Thank you, Sarah. And thank you, everyone, for the questions that are coming in. Please do continue to submit them, and we will answer them based off of where we are in our presentation. One question that did come up that I will answer now before I move on to my section was regarding how long does the refinancing process take? Specifically, this question was regarding home loans. It's going to depend who you are working with. I have had friends that have been refinancing and it took up to 3 months. I refinanced myself and it took about 30 days. I refinanced with us at the credit union, and that actually brings me up to another point. If you do have one of our loans, I would contact our mortgage loan originators. You may be able to refinance the loan that you have with us, and if it's a better rate. So that could be something else to be aware of. As for a couple other questions, does HUCTW handle 20-year mortgages? Yes, we do. I would say if you have any specific questions, I did drop this in the chat, but I want to make sure you all saw it. If you do have specific questions, like Sarah said, reach out to the mortgage loan originator. You do not need to be a member of our credit union to do this. And you don't have to go with us if it ends up not being a good option for you. But our advice and our information is always free, and we're here as a resource. So you can definitely, we've done this. We've had individuals that will talk to our mortgage loan originators and bring other offers and just say, I'm not quite sure what this means. And we will be the first ones to tell you if it's a better option to go with them versus us. We want what's best for you. Another question that came up regarding credit card repayment, credit card refinancing, debt repayment, how long that takes. Auto refinancing will typically take about a month to 2 months. Educational loan, it usually takes the same. Mortgages are the ones that typically will take longer, and it just depends because there's so many different pieces. You have to involve the city. Their payoffs are significantly higher, so it takes a little bit longer, but everything else usually takes about a month or two. And for credit card balance transfers, typically will take about the same. Okay. Well, thank you again for all those good questions. So now that we have a better understanding of sort of a basis of, I first need to understand what is my current situation, make sure I have some funds put aside so that when life happens, we can utilize those funds and not put ourselves back in debt. Because that's one of the things, we want to make sure that this is something that is achievable. And sometimes what we have seen, we've seen individuals that maybe do refinance, whether that's their student loans, their home loans, et cetera, and then something else happens and then you have to go into debt. So that emergency fund, budgeting are very important. We also know that having a good credit score is important because once you have that good credit score, you could be eligible for typically the lower rate. I do want to point out that depending on what you're refinancing, credit may or may not be as important. What I mean by that, I'll speak to our home loans. Because we are a not-for-profit, once you are eligible for our home loans, everyone's eligible regardless of rate. So that is something else, as Sarah mentioned, like you want to check with whomever you're comparing options to see if it is based off of your credit score. Sometimes if you qualify, you just qualify. But now that we have an idea of how to refinance, what are other repayment strategies? And you'll see on the next slide that there are different types of strategies. And I'll go through all of these so that you can sort of identify which one may work best for you. There is never a right or wrong way to do something when it comes to refinancing and repayment, because ultimately what works for Sarah may not work for me. So if I do what works for Sarah, that's the wrong way for me. So really it is personal, and this is important because as you're speaking to friends, maybe colleagues, family, they might say, well, this is how you have to do it. Ultimately, what's going to lead you to your success is the right way for you to do it. Now, there are a couple of different methods. Snowball is one of them. And, we are New Englanders. We did get a little bit of snow a couple weeks ago, depending on where you were. But essentially, for most of us that have made a snowball, and for those that haven't, maybe in the next couple of weeks, we'll get a little snowstorm and you'll have a chance to. But you usually start with a little pile of snow, and then you add just additional snow until you get a bigger snowball. And if you want, you can make a snow person. That is essentially a strategy that is utilized when it comes to paying off debt, where you focus on the smallest debt first. So let's say I have 3 different debts, and they could be whatever you want. It could be credit card, loans, whatever you want. Let's say I have debt A that I owe $500 to. I have debt B that I owe $1,000, and then I have debt C that I owe $3,000. Based off of the snowball method, I'm going to decide I want to just pay off the smallest one first and then focus on the others. So I would focus on the 500. What does that mean with the others? Does that mean I stop paying? Of course not, because if we stop paying, that will negatively impact our credit scores. But what that does mean is if I have a certain amount that I'm able to pay, and I would make the minimum payments, and let's say that I'm going to always use simple math because I'm usually doing this in my head as I go through these. So let's say I have $300. I have 3 debts. Instead of doing 100 to each, assuming that would meet the minimum for all of them, I would say I would pay the minimum on the $1,000 loan and the minimum on that $3,000. And let's assume the minimum for those is $50. So $100 would go towards that, but then the other $200 I would pay on the $500. So essentially, I would make the minimum payments on my other 2 loans, and I would make extra payments on the first loan. Why would I do this? Well, for some of us, and I can speak to this, I'm one of these individuals, I like to have lists, and I like to just cross things off the list. And it's something, to me, it's satisfying, and essentially it's a little bit of behavioral science. It's goal gradient. It means that when you have multiple goals and you break it down into smaller ones, when you start to see success, you're more likely to stay on track. That is why earlier when Sarah was going through the emergency fund, instead of trying to calculate how much do I need for 6 months and looking at that number and saying, well, that's not going to happen and giving up, we break it down into those smaller goals. If you're a person that likes your to-do list, if you're the individual that would write something on your to-do list that you forgot, even though you already did it, just to cross it off, the snowball method may work best for you. If you, on the other hand, are the type of individual, let's say right now at home or at work, you have a lot of different things to do, and there's like this one project that you have to work on that you know you have to do it, but it's going to take the most time. It's the one that you're sort of dreading, but you're going to focus on that one first just to get it out of the way. The avalanche method might work best for you. That is when you list all the debts based off of the different interest rates, and you focus on the highest interest rate first. When you do this, that is the one that's going to technically save you the most money, assuming that you don't accelerate payment on anything else. However, you're going to typically have to wait a little bit longer to see success. So if you're okay paying off the highest interest first, but maybe not technically paying off that loan till 2-3 years, depending on your situation, that's a good strategy for you. If you much rather have successes met sooner so that you can sort of celebrate those, snowball may be best for you. And if you much rather just put the money anywhere, you're sort of in the sprinkle. You're just putting those extra payments as you'd like, which still is a repayment strategy in itself. So in addition to different repayment strategies, we wanted to give you some numbers. As I mentioned, I'm a numbers person, visual, so wanted to give you a couple of examples to just show you how this all works together. We're going to take a debt of $10,000, 18% for 5 years. What could it be? It could be a credit card. It could be a student loan. A student loan, actually, that's a little excessive for a student loan, but it could also be credit card. Typically, we'll see it. I've seen it at car loans this high as well. And for 5 years. This means that my monthly payment would be $254, and that the interest over the life of the loan would be $5,236. And this goes back to what Sarah mentioned earlier, which is essentially telling us what is the cost of borrowing that debt. This is an important number because when we think about it, most of us could do something else with $5,200, then give it to a lender. And if you cannot, feel free to message Sarah or myself. We will give you different things that you can spend your money on other than giving it to a lender. So what if you were to refinance? You'll see on the next row that if you were to move forward and refinance and keep the same term, and terms is just a fancier way of saying year or repayment period, you would save, in this case, almost half of that interest. You may be wondering, 18 to 10%, is that doable? As Sarah mentioned, the rates are fairly low right now. So if you have a car loan that's over, let's say anything over 4%, definitely would look into refinancing. You have credit card debt, anything over 10%, I would look into. if you have a mortgage, anything over 4%, I would look into. So essentially, I think anything over 5% is a good starting point for you to look to see, because you may qualify for a lower rate. So we have seen individuals that drop 8%, but even if you don't drop 8%, you can still save money. Now, another repayment strategy is once you do refinance, you're going to be given a monthly payment. In this case, when I refinanced, I was given a $212 payment. But if you are comfortable making that $254 payment, that is going to help you pay off that loan faster and save you a little bit more money. And if you're anything like me and just like to budget with easier numbers, 254 to me is just a little bit of a, I mean, I know it's an even number, but it's an odd number in the sense like 254. I'd rather budget for 275 if I can afford to make that little bit of an increase. That's going to save you a lot more money. And you'll see here that it's not just the amount that you're saving, but it's also the time. So in this case, just by doing these different things, we've paid off our loan a year and a half earlier, which I like to think of it as that's a year and a half of me having more financial freedom. That's a year and a half in which I can take that money and apply it towards something else. I can apply it towards any other goal that I have, and that could be repaying other debt, or maybe that is saving, or whatever it is that motivates me to stay on track. There are situations that we understand that the debt may be higher than income allows you to pay off. So some of these strategies may not work. So we wanted to give you a couple of different options, another one being a debt management plan. So you'll see here on the debt management plan what it is, and I'll walk us through it, but I always start with what it is not. Debt management plan is not debt settlement. Debt settlement is something that you will hear often, and the debt settlement, typically you'll hear this on radio stations, commercials, late night TV, but debt settlement is when someone tells you, do not pay that creditor, and they'll cut your payment in maybe half. Yes, they may be able to do that, but that will have a negative impact on your credit score. And it also could impact your ability to get debt, not just because of the credit score, but on the credit report. Underwriters, when they look at your credit report, will see that it was settled, and they may decide not to lend to you because you've settled with another lender. Who is to say that you won't do the same with the debt that you now take on with that company? A debt management plan is different because it essentially, you're working with an organization, and we partner with Green Path Financial Wellness, but there are others out there. But you're partnering with a not-for-profit organization that will put you on a plan, hence the plan in the name. But they work with you, you create a budget with them, they talk to your creditors, and they will do, well, what they will do is instead of reducing the amount, they're going to work with the creditor to reduce the interest rate that you're being charged, so that more of your payment would be applied towards the principal instead of interest. We have seen some of our members, their interest rates have gone from double digits to single digits. Typically, debt such as credit card debt that are specific to store cards tends to be one of the most common ones, but we've also seen financial institutions, their credit cards have been put into these plans as well. There is a cost. It's $10 per account if you're in the state of Mass. It is based off the state. Debt management plans are regulated on a state level, which again makes it more focused on the consumer. They're here to help you versus debt settlement, which is not really meant to help you. It's more to help the debt settlement organization. As with anything, there's a lot of fine print. So you'll see on the next slide some information. This is more, you'll get these, as I mentioned, we will be emailing you the information, so you'll get this. But more importantly, when you talk to Green Path, if you are in a situation that this would benefit you, they're going to go through all of this. We would never recommend anyone sign up for this if it doesn't make sense for their situation. And just like anything, you want to just always weigh the pros and cons. Green Path information is listed here, and you can also go onto their website. In addition to debt management plan, they also provide budget counseling, credit report review, and they are doing COVID counseling. You do not need to be a member of the credit union. As a not-for-profit financial institution, focus on the well-being of all of us here at Harvard, including our students, the staff, and those in our households. We pay for this at HUCTW so that it's available to you and those in your household for free. And they also have help in different languages if you prefer, or if someone else in your household prefers to speak in a different language. A question that came up, how does a DMP impact your credit or ability to get future loans? That's a great question. I like that for a couple of reasons. You're thinking not just about the now, but the future. A DMP is not a credit fix. It's not going to fix your credit instantaneously. It ultimately will help your credit score because at the end, towards the end, because you will be making more payments on your debt. So therefore reducing your debt to income ratio, allowing more essentially ability for you to borrow in the future. But at the beginning of a debt management plan, most of the debt is being not restructured, but essentially you're not going to see the benefits. So if you, however, for most individuals that tend to get onto a debt management plan, it is common for them to usually go in with not higher scores. So it does help. But I would definitely, if you want more specific, Green Path counselors can walk you through that. And all of these conversations are free. I do want to point out that Green Path does offer student loan counseling and home counseling, mortgage counseling. There is a cost associated with those. If you want to pay, you can. I, however, recommend take advantage of the free services HUCTW has to offer. If you're in school, take advantage of the financial aid office that is available to you. We do work at Harvard, so maybe some of you have friends or work in your own financial aid offices, so you may know more about student loan counseling before paying for those services. I know we went through a lot, so I'm going to start going through some next steps, but I do want to open it up again and remind folks, if you have questions, do submit them during this time. Sarah and I purposely left ample time for questions because we wanted to make sure that we address any questions that you may have. So as for next steps, the first one is knowing your starting point. This is probably going to be the most challenging, and I do want to speak to, there is emotion that goes along with this, and it's okay to have those, and it's okay to acknowledge that. When you're going through this, listing the debt and seeing how much it's going to cost you, it's probably the best feeling to see, like, I'm going to pay $20,000 in interest, I'm going to pay $5,000 in interest. However, I'm going to say take that as motivation. Sometimes we need to see what that future looks like for us to make some changes today. But in order to do that, keeping in mind saving for tomorrow, I've been doing these presentations for over, I think approaching 5 years now here at Harvard, and we've always have said, save for emergency, you don't know what's coming, and 2020 hit. So definitely save for tomorrow. We don't know what 2021 will be. Hopefully it'll be better, but we do anticipate it may be a little bit rocky. It may continue to be a little bit financially rocky. And understanding what you owe. Some of you submitted these questions, which was great, asking, well, what do I owe to this lender versus that one? And knowing your personality at the end, it's all about you. So what works for you is what's going to be beneficial. Find things that are going to work in your favor. If the repayment strategy isn't doable, you're not going to stick to it. And trying to reduce, not add debt, which we know is challenging. And this is where having that budget is going to be important. We have done budgeting presentations before. You can get more information on our YouTube page, our YouTube channel, and also on our blog. And you'll see on the next slide, we do have a blog in which we put articles out about 3 times a week. Sometimes a little bit more often, sometimes a little bit less, but on average, it's about 3. And here you can see we had some folks ask about home refinancing. If you're not at that stage, we do have information about home buying. If you are how to financially prepare for a disaster, like a weather-related disaster, and then some information for saving during the holidays. And at this point, I'm going to turn it over so that we can have questions submitted. And also Danielle and Laura are here from HUCTW. So if there's anything that would be beneficial for you to share with those that are on, feel free. Or if you have a somewhat HUCTW finance related question, they can also help answer those as well. Okay, one question that came in. My wife and I bought our first home in June. Congratulations. How long should we wait before looking into home improvement refinancing loans, given the current state of interest rates? Is there an amount of time we have to wait? I actually wouldn't wait. I would start the process of talking to someone now. I would reach out to a mortgage loan originator. That happened in June. You're paying on that loan. You may, if you may not have, it depends how you're trying to refinance, how you're trying to do that home improvement. If you're trying to do a home line of equity, you may not have enough equity, or you may. It depends where you bought. There's so many different factors. So I would actually reach out to a mortgage loan originator to have those conversations now. As Sarah mentioned, it is a busy time. So speaking with someone now is going to benefit you, because it just gives you more information. And the more information we have, the more empowered that we are. Oh, thank you. Someone mentioned that the blog link isn't working. Thank you. I think you have to have the HTTPS in front of it, but it is blog.hbcu.org if you put that in directly. But thank you for letting us know that the one that we put in isn't. Oh, another great question. When you refinance, is it only for the amount of your student loan, as an example, or can you get more and then add a high interest credit card or debt? So there are a couple of parts in that question. I will use a home for an example. I think a home is a good one that we've seen this often. When you refinance, you sometimes can add on additional debt. And sometimes, depending on your situation, you may need those funds, such as in the case if you're trying to do home improvements, or maybe the rate is low enough that you want to have a little bit more of those funds available for some other project. So depending on the loan, typically home loans, you can borrow more than what the amount that you're refinancing is for. Auto loans typically cannot. Auto loans typically are capped at 80, 90, or 100% of the value of the vehicle. Sometimes it will depend on the lender, but it does, that one does vary specifically. As for can you get additional products when you refinance, depending on the lender, they may use the same credit report so that they only pull it once. And if you were applying for something else, it still would be a separate, you're applying for a credit card that you're getting but it's not a part of your student loan. So it's a separate product. Just happens to be that they may use the same the same credit report. Yeah. And thank you. Someone did mention that the https://blog does work. So thank you about that. So if you just get rid of the www and do the https://blog.hbcu.org, it will work. Thank you.
Hey, Magnolia.
Another. Yeah.
Oops, sorry about that. I know we didn't speak much about credit card balance transfer things, but I know that we're about to come into a time where those are extremely popular. So I didn't know if you just wanted to do a quick, thought on credit card balance transfers and the specials that may be happening and kind of the strategy around that specifically.
Thank you, Sarah. Yeah, it's a really good point. So right now, typically during the holidays, this year might be a little bit different, but I actually wouldn't be surprised if people end up spending a little bit more. But typically people will spend more money on their credit cards during this time. And what tends to then happen is that at the beginning of the year, you then get that credit card bill and you're trying to think of ways to pay that off. Many of us go into the new year possibly with resolutions. So a lot of organizations will usually offer lower credit card balance transfer rates at the beginning of the year. What does that mean? Credit card balance transfer is another way of saying refinancing, but specifically to credit cards. So what happens with the credit card refinancing is that you will take the debt from credit card A. Credit card B offers you usually a 0% introductory rate for about sometimes a year, 18 months, depending on the credit card company. Credit card B pays off credit card A, and now you have, let's say you had $10,000, now you owe that $10,000 to credit card B at 0% for the first year. Then after that, the rate would go up based off the market. You may hear that and think, oh, that's wonderful, and it is. It's a great option. However, we have to go back to our personalities. We tend to think that the future sometimes will be able to do things that we can't do. It's called planning fallacy. We think we can get all this done in a year and may not actually be able to. So unless we put ourselves in a plan before we do the balance transfer, it may not be successful. Going back to this $10,000, if I have it, and I'm just going to change that right now to $12,000 for easier math. But if I have $12,000 credit card balance and I transfer it and I only have a year, unless I pay $1,000 a month, or I'll essentially plan to do that, or have major payments that I make, I'm not going to be able to pay it off in a year. So one of the recommendations that we do is really to budget how much you can pay and only utilize that credit card for maybe a subscription, so that you're using it, but you're paying it off in full, and you're paying off the monthly amount that you've calculated so that you can pay off your debt within that 1 year period. A couple of other questions that came in, and I'll sort of tackle these quickly, but would that balance transfer option affect my credit score? Anytime that you do a refinance, whether it's a balance transfer or anything along those lines, typically it will impact your credit score. It's sort of like a seesaw. It goes up and down. So it goes down because you've applied for new credit. So that's a credit inquiry. So there's an impact on your credit score. And it's then a new line. It's a new line of credit. But then that other debt that gets paid off, so that helps you bring up your score. And if you have a plan and more of your payments are going towards towards principal, your debt to income, or the amount outstanding of your debt, is going to be, not debt to income, but the outstanding credit amount that you have, that is going to increase. Available credit will increase because you've paid off more of your principal. So it's a very long way of saying that it will typically impact your credit score negatively, but as long as you continue to stay on the path of repayment and don't add additional debt, on the long run, you tend to see more positive aspects. It is another question: is it possible to refinance collection debt? You may be able to. It depends on the lender. We have done that, and we do that for our members at the credit union. It's essentially part of a debt consolidation loan that we offer, which you can put debt that it is in collections as a part of that. How challenging is it to get refinancing a loan with bad credit? It's going to depend on your lender. Some lenders, and I can only speak to what we do because that's, I work here, so I know what we do. But for us, if we cannot refinance your entire debt, we will work with our members and we'll do whatever we can. And then after a couple of months, have you come back. So we will work with our members. Not every lender may be able to do that. So I would check with a couple of different lenders, but having a lower credit score is not a reason to think that this is not an option. As I mentioned, GreenPath provides free credit counseling, so they can help you bring up your credit. And they can also, if you work with someone such as with us at the credit union and with GreenPath, that's a strategy. You sort of have a team, whether it's us that you're working with or your other financial institution. GreenPath can help you as well. Okay, another question that came in, and I'm just going to paraphrase. Essentially, you can refinance. There are times that when you refinance, the rates could be higher. That is true. Sometimes individuals may choose a higher refinancing rate because the term may be longer, so that the payment amount is lower, the monthly payment amount is lower. And if you're trying to increase your cash flow, some individuals may do that. However, just keep in mind, like you said, because the rate is higher, and if you're not going to be paying as much, it will cost you more in the long term. But there are situations where if you need the cash flow for other expenses like rent, day-to-day living expenses, that may be a temporary option. But you may just want to then, after a year or two, or as soon as you're able to, then refinance or prepay so that you can be done with that loan faster. Another question: do you need an existing HUCTW account to refinance an auto loan? No, you don't. And we actually, anytime you're buying a car, even if for those that may be interested in buying a car, you can always buy a car, go with the rate at the dealer, and bring it to us like next day. You can also on our website get an estimate of how much you would qualify for a loan with us before you go to a car dealer. And then that way you can, I wouldn't tell them that, oh, I could get 3% with HUCU. I wouldn't tell them that. I would just keep that in your back pocket as a negotiation piece. But you do not need to have a current loan with us to refinance one. Another question, does the debt consolidation loan have an introductory rate similar to balance transfer? So debt consolidation loans tend to be beneficial and a good option because it is a fixed rate for a fixed time period. So for ours, it's usually 7 years, 7 or 5 years, and the rate I believe is a 7.5, but do not quote me on that. I would check our website, but it is fixed. So it does not have an introductory rate, and that tends to be the benefit, is that because it's fixed, your monthly payment will be the same and you can budget for it during that time period. If you do a balance transfer between existing cards, does that affect your credit score? It could impact your credit score because credit utilization is important. You want to try to keep your credit utilization, meaning if I have a credit line of $1,000 and and I owe 500, that will have a more negative impact than if I owe 300. So you always want to try to keep your debt to about 30% or lower. 0% is great too, of what your credit line is. So even if you already have that existing credit card, if your credit line is 10,000 and you transfer over debt from another card and now it's 7,000, your credit utilization is at 70%, and that typically can have a negative impact on your credit score. And I know we're coming up on time here. I think I have another question that I may turn it over to Laura or Danielle or Sarah if they have any closing thoughts. Does checking on the website impact your credit? It depends. Some companies will do a soft credit pull, which will not impact. Most of them will disclose that. In order for someone to pull your credit report, you have to authorize it. And as part of that, they have to disclose whether or not it will impact your credit score. Thank you, everyone, for all these great questions. I hope I didn't go too fast. I was trying to get them all in before 1 p.m. But I'll turn it back over to you, Sarah or Danielle, for any closing comments or additional thoughts.
Thank you so much, Magdalia. I really appreciate you and Sarah taking the time to talk with us. Every time we see these questions, it reminds me how many variables they are and how valuable it is to have people like you to answer these kinds of questions. So really, thank you for sharing all of this with us and for answering the questions and for continuing this series. Just because on a few slides ago, planning for disasters came up, I just wanted to mention that any HUCTW members who have sort of natural disaster kind of things that happen at home are likely to qualify for our home emergency hardship loan, which is a partnership through the credit union, and that's a 0% interest program we do to help people with things like that. So if a tree falls on your house or your basement floods, please reach out to me as that's available. And as I said, those loans are 0 interest. There's almost no cost to members except for an origination fee. And if people on this call are looking to rebuild their credit as well, making on-time payments on those can be, a positive on your credit report over time. But big picture, thanks so much, Magdalia and Sarah, for being here, and to the credit union for all your time. I can't wait to continue this in the new year.
Thanks so much, everyone, for joining us today, and we hope you have a wonderful rest of your afternoon and a wonderful holiday season.